Welcome to our webinar, and thank you for taking the time out of your busy day to join us. I see that we have attendees from all over the country joining us today. Welcome. We're happy to partner again with one of our most popular speakers and a professional trader with over 30 years of experience to bring you this trading webinar on a very timely topic: ride bullish and bearish swings with options. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, Investrade. A few housekeeping matters before we start. The session today will last approximately 1 hour. Our speaker will present to you for approximately 45 minutes, and then we'll open it up to Q&A and answer all of your questions. We ask that you look now to locate the Q&A box on your screen. If you have any questions during the webinar presentation, please feel free to type them into the Q&A box, and our speaker will answer those at the end of his presentation. We ask that you use the Q&A box and not the chat box, as our speaker will only see what's in the Q&A box. And to tell you briefly about eOption, as our name implies, we're a brokerage firm that specializes in stock and options trading. We offer you some of the lowest rates in the country, including zero commission on stocks and ETFs, and options are just 10 cents per contract. And you can trade on our powerful trading platform as well as our mobile app. Our founder was one of the founding members of the Chicago Board Options Exchange and has been an active stock and options trader for over 45 years. He created his ideal trading company that caters to those who have a passion for investing. At eOption, we support trading education, and we encourage you to subscribe to our YouTube channel to see our library of trading videos, no matter what level of investing you're at. We recently revamped our entire page and have playlists on whatever you're interested in. You can go to youtube.com/eOption and take a moment to subscribe. And if you subscribe, you'll also be notified as soon as when a copy of this recording is available, which should be tomorrow. We also encourage you to visit our website at eoption.com. You'll find all kinds of educational materials to learn more about options trading, as well as our past webinars and videos. And I'd like to turn our attention to our speaker now, Teddy Keckstat. Some of you may recognize his name from past webinars he's done with us, and he's one of our most popular speakers. We'd like to welcome him back today. Teddy is a professional trader and has over 30 years of trading experience. You'll see that he's very passionate about the markets and educating others. He's currently president of Forex Trading Unlocked and the author of the book, High Probable Japanese Candlestick Patterns. And without further ado, I'll turn it over to Teddy Keckstat now. Thank you.
Thank you, Gina, for that introduction. And hello, everybody. Appreciate you taking your time out of your day for this webinar today. So ride bullish and bearish swings with options. Let's get started. So we can skip past my background. Gina already had that. So for all you bulls and bears out there, let's get ready. We just want to show you one really quickly that the eOption disclaimer to remind you that this webinar is for illustrative and educational purposes only. Everything has a big time delay on the stuff that we're talking about, even though it is current affairs. And I always show my disclaimer as well for every type of webinar I do. All right, so the parts. First of all, we're going to be dealing with stocks, the underlying assets. We're going to be dealing with call options, which give you the right to buy an asset at a fixed price. We're also going to be talking about put options, which give you the right to sell an asset at a fixed price. We're going to talk a little bit about the length of time before option expiration, but not get heavily into the Greek mathematics about that. We're going to also show you how to integrate call option strategies into your trading plan or any trading plan, how to integrate put option strategies also into your trading plans. Now, what is the proper way to manage the options before they expire? We're going to go over that as well. And we're going to show you how to take advantage of directional option trade setups. Okay, so in order to do these things, we're going to explore a couple of fundamental and also technical things. On the technical aspects, we're going to deal with a little bit of Fibonacci, which gives us price projections. We're going to deal with trend analysis, which is very fundamental, but is definitely very important. We're going to deal with some basic moving averages. We're going to go over order entry for placing these potential option trades. And we're going to go over platform execution, and what you will go through as you place these trades. And excuse me, we'll also follow up with how to monitor these trades. Okay, so how do you make and lose money? Well, depending on the situation that we discuss here. If you just buy the stock, the asset, and the market goes up, you would profit. If you buy a call and the market goes up, you also would have potentially a nice profit. If you buy the stock and the asset goes and the market goes down, that means you would be losing money on that type of investment or trade. If you buy a call and the market goes down, your risk of loss is defined. When you buy an option, you can only lose the amount of money plus your commission that you initiated your position with. That is the maximum you can lose. There is no risk behind that. Your stress level stopped at that dollar amount. When you buy a call, it is a bullish position. So you're looking for the market or underlying asset to go up. When you buy a put and the market goes up, your risk of loss is defined conversely to the call. So that means the position goes against you, because when you buy a put, you're looking for the market to actually go down. So when you do buy a put and the market goes down, you profit, and that your profit will be indicative of how much time is left in the option and how far the market moves. When you are buying a put, remember that it is a bearish position. So let's start to see how these things work. Okay, we're going to follow a couple of case studies for these option strategies. We're going to go over one example, which is with HP, not Hewlett Packard, it's Helmerich Payne. We're going to talk about managing a trade with that example. INT, World Fuel Services Corporation. We're going to talk about managing a trade with that one as well. If you watched our last webinar, we had dealt with these stocks as far as picking different buying investment potentials for different markets. And also DraftKings, we're going to learn how to manage that trade and enter a bullish trade. And then we're going to talk about Peloton. Peloton's been in the news a lot. So if you're not familiar with DraftKings or these other ones, I'm sure Peloton, many of you are familiar because the commercials are on every single day. So at this one, we're going to talk about how you enter a bullish trade and a bearish trade, not a spread. So we're going to talk about how you can play this market depending on what your opinion is or your belief in the future of this company. And then we're going to talk about good old GE. It's a staple of the market for generations. And we're going to talk about how to enter a bearish trade with that one. So we're going to cover different aspects of going up and down. And so for your bulls and bears, we'll show you how you can integrate these types of methodologies, applying them to the stocks or assets that you trade. All right. HP, the first one that we are looking at here. Okay, so as you can see with this market right here, it overall looks kind of sideways if you go from September back to where it was currently at the beginning of February here. So the market had bottomed at the very beginning of December, and then after that, it had made a lower move high. Now, when the market is making lower move highs and lower move lows, that is indicative of a downtrend. So you already get a basis of where the market's going by gauging where the highs and lows are. So after it established this lower move high, the market kind of stabilized, was a little bit neutral, and then it bounced. And you can see that there's these two averages that crossed here. One is the 13 and one is the 21 day. So the shorter term average started to already bottom, flatten out, and then start to rise. The market popped up, and what did it do? After it crossed, it made a higher move high. So now, does that mean all of a sudden you have a bull market? Well, not necessarily, but it definitely means that the bearish trend that was in place, because it had been making lower move lows and lower move highs, that at least was off the table. It started to stabilize. So a neutral trade would be where you look at from this area here, okay? And you can see that the longer term moving average here is still above the market and pointing down. So when this is pointing down, the longer term intermediate trend is still basically sideways to lower as far as the outlook for the trend analysis. But short run, we have a low and we have a higher move low established also. So when these cross, you can see here we made a higher move high, and then we came back and we made a higher move low. Right in the averages here, we're starting to both turn upwards. Okay, they didn't cross underneath, so there wasn't weakness. The short-term average, the 13-day, is still above the 21, which is bullish. And because we had this initial low here and this second low here, this becomes our basis for the upside correction. So no matter what, since you're making different when you go from making lower move highs and lower move lows consecutively and you break that pattern, you know that a neutral to a bullish trend is establishing. So this gives us a reason to build a baseline here for potential support. So what does that give us as far as an options trade or a stock trade? Well, if you were looking at this company and you didn't own it and you were looking to find a good buy point right now, that would possibly be a very good buy point, just because the short-term trend analysis is showing you that the market turns. So you could buy the stock, and it's trading at this point was trading right around the $25 strike price, just below it. So if you were to buy 100 shares, you're looking at a $2,500 investment. Okay. Now, if you buy the option, the pricing is different, and we'll get into that once we explain what way we're going to go with this. So let's say that our bullish scenario is the way we want to go. Well, we need to have an idea of where is it going. Okay. So from this high, this last big high, to this major low here, this was where our downtrend was very dominant. Once we establish this low, this has become the basing point for your correction. Okay. So now when you have a correction, it's a counter trend move. Remember, this market was going down. It was a bear. It's having a counter trend bullish move. Okay. So we know that the trend analysis from the highs and lows is confirming that we have a neutral to higher outlook. So where do we look for an upside retracement to go up to? Well, we use the Fibonacci from level, taking this high and this low, and we see right here, this 0.50, this 2822 right here, this gives us a target line right around this area here. Okay. Now 50% for Fibonacci and Gann, and also going back to the trading floor and for basically a few hundred years, is 50% rule has been a gravitation point. Does that mean that the market stops on a dime? No, that doesn't mean it's even going to make it to the 50%. No, but if it does get to the 50%, it does give you ideas as a trader what to do when the market does come to that type of a move. So that's an expected target point. Okay. Now, if it's just a correction, this would be about where it runs out of gas, or maybe this 0.618. So this area right here from 50% to 0.618 gives us our upside target zone. Okay. So now what do we do with this? If we buy the stock, we know we can hold it indefinitely, and it costs $2,500. However, there's a February 18th, 2022 option that expires that is giving us over a month and a half. And that's a nice term for when you want to have a short-term trade. Now, why would you use the call option versus buying the stock? Okay, well, if you buy the stock and you're right and the market goes up, well, you obviously know that your value of your stock purchase will be in your favor. If the market goes lower, then your equity interest decreases. You still own the stock, and you would still own it past this February 18th if you like. But the market could be at $20, it could be at $15, it could be anywhere. Now, since this market was already in a bear trend to begin with, and we've already come to the conclusion that at least in the short run, this is a corrective move higher. You never want to try and pick a bottom or a top, folks. This is very important. I don't care if you're beginning, you're just your stage in the beginning stage of trading or investing, or if you're experienced, you have to make sure you're very disciplined on these things. Okay. So knowing that it is at least a corrective move, the sensible thing would be to try and minimize your risk and also maximize your potential return. So now let's say you wanted to buy the stock. Well, the smart thing to do, in case you were wrong, would be to have a stop somewhere below this first higher move low. Okay, because anything that falls below there means that this market is definitely in neutral to resuming its potential longer term bear trend. If that is the scenario, holding the stock without putting a stop in the market means you have a much higher risk of loss. Okay. Now, if you put the stop in, that means you'd only lose about a little less under $300 or $3 a share. Okay. So on the 100, you lose basically around $275 if you bought the stock and then the market fell lower. Okay. But then you're out of the market completely. So this market could fall anytime before February 18th, stop you out, and then turn around and all of a sudden rally in a big way. I mean, markets can obviously do what they are going to do what they're going to do. So, but as far as a situation you can capitalize on, the option gives you the better advantage here. So either buy the stock at 25 or buy the option at 25. I'm going to show you what happened with the option, and we'll see how this works. Okay, so instead of buying the stock on the e-option, now this is the from the paper trading platform, which, by the way, if you want to, when you log in, you go on the e-option platform, you go for login, it will either say the live trading or the paper trading. The paper trading is what we're using here for the demo for these demonstrations. So the orders still work the same. So if you look on the right side here, it says option ticket. So option is the trade, HP is the symbol. Action here, it says buy to open, quantity 1. We have the expiration here of February 2022. The option strike price was $25. The type of option was a call. Now, this is very important. Make sure that, because this is a position where you're looking to be bullish, you're looking to buy. So it's a call. You're looking at the upside. Okay. And then it has the bid and the ask. So the bid would be the price that if you were selling, and we're not talking about selling, that's for advanced traders. But buying would cost $1.75. Now, remember, with options, everything is multiplied by 100. Okay. So that would be, $175 to purchase one. Okay. And you can see that here, HP last, it's telling you where it was trading last, the change and the bid and the ask and the volume. So you have this information all at your fingertips. Okay. Now, once you hit the go ahead for it, it's going to give you a verification result to make sure, to just double check that you're putting in the right order. Now, if you look at this verification result, it has your account. Okay. And then it says buy to open. And then it says 1. That's the number of contracts that we had stipulated of HP. Once again, the underlying stock of the market that we're looking. And then the February 2022 $25 strike price call. Okay, so this 25.00 is $25. That's the 25 strike price. And as you look down here, the order was a market order. There's other types of orders to use. And in these examples, we're just using market orders. Okay. Estimated cost of the position, $175 per trade commission, blah, blah, blah. It shows you a breakdown here of your OCC fee and other the fees that you have to pay on regardless of no matter what per trade. And then you have your estimated net cost. So the total value of this option at the execution would be $177.16. Okay. So after you hit the verification, then it goes to market after you've confirmed that you're placing the right type of order. Now you have your order placement status. So it looks very similar. Now the market, you can see it says status. It says filled 1 from 1. And it gives you the estimated cost. So you did get the price on that one, and the total cost was at $177.16. So now what does that mean? That means the only risk you have is $177. Now, remember I said when we were looking at the chart that if you bought the stock, okay, if you didn't put a stop in, who knows what your potential risk of loss would be on the stock. And if you traded it based off of trend analysis and having proper money management, you would have a stop in. And if you would have done that in this situation, you'd be risking, once again, remember we said it was about just under $3. So you'd lose around $275. So let's say that for all intents and purposes that we put this trade on as an option and also as a stock. What would be the difference? Well, if we put the stop in the market, that would mean that if the market fell below that low, you no longer would have your stock position. Okay. And it's not February expiration yet. It's coming close, but it's not there yet. So when you think about that, your option gives you a little bit more leverage as far as your time and how the price goes. So you don't have to have all that stress and your risk. Well, let's say we're wrong on the whole buying of it, and there was just a very short-term correction. The market fails and it goes lower and lower and lower. Well, the option, the worst you could have lost on that was $177. Remember, I said if you bought the stock and you were still using good money management rules and you used a protective stop order, you would lose 175 around that, or excuse me, 275, a little under $300. So you can see that by the use of an option, you would be saving more money on your potential risk of loss and still have the same potential for the upside, although you have the time issue that the option does expire. Okay. So now let's go look at another example here, or what happened. So we have HP. Should you buy another call? Is it time to buy a put? So as you can see, this is where we had the entering of the strike price here. Okay. Then the market broke out to the upside. Remember how we had our 13 and our 21? They were just staying above, trending higher. This was our last slide where it ended right here. The market broke out over the next few sessions and it came above the 50-day moving average. Why did we have the 50-day moving average? Well, the reason I didn't say anything before is because now it'll show you why it's a big number. When you cross the 50 or the 200-day moving average, they're very big for a lot of the funds that trade all types of equities. When the overall broad market, the indexes hit those levels, fund managers will start to look to adjust a lot of positions. And especially when you have like a situation like this, if you had a position already or didn't have a position, you would possibly get in. And if you did have one, you may even start to add as the market gets above this 50-day moving average. Okay. So this is the funds, they don't get in at tops and bottoms. They don't try and pick them just like you shouldn't. But they do, they're always scaling in and scaling out. So when you know that when, especially like these averages here start to rocket up, the 13 and 21, helping to secure your trend to the upside, and then you blast through this flattening curve here from the 50-day, that's a very bullish sign. You know what else is very bullish? After we had broken out to the upside, we established a higher move high. The market came down, made a higher move low. And remember our support line that we drew before? Remember we had the initial low and then our first initial higher move low. Well, look at this. The market continued to channel. And as it did come down after, this was the most extreme break that it had over in a month and a half, turned around. Then it held this 50-day moving average and the market screamed higher and made a higher move high. So what should you do? Should you buy another call? Is it time to buy a put? Well, the upper end of the upside target range had already been met. Okay. And we're in front of the February expiration for this trade. So what would you do? Well, the smart thing to do would be to get out. Okay. For two reasons. You had already hit the upper end of your target range. So part of money management, just like how you establish how much you're willing to risk, you should always know how much you want to make, and in this case, you were giving a good bang for your buck as far as how far the market would move. I mean, we remember the market was trading just around $25 when this position was initiated for the option. It went up to 32. You have above $32. That's a $7 appreciation on that stock. Now I want you to think about that. What does that mean as far as a $7 appreciation? Well, that's over 25% on your money in just a matter of a month and a half. Now, I don't know about you, where you have your money and what bank you're having it in, but I don't think you're getting 25% on your money. Now, in our example, had you bought the stock, obviously, you wouldn't have been stopped out and you would still own the stock. At this point, since you already had gone through your target level, a trade or an investment, like I said, you define your risk. You should also define your profit objectives. That would be a time to get out of it. So how much would you make on that trade? Okay, well, you would have, at this point, you'd be up a little over $7 on the stock. Okay, so you'd be up a little over $700 on that position. Okay, now as far as the option position, remember, you had less at risk. You had 2/3 of the money at risk. Now let's see how things worked out. So if you look at HP for the Feb option there, the market was trading at 760 with an 8 even ask. If you look at up here, okay. So with this right here, if you look at that number, as far as where you gotten in, remember our average opening price is $1.75. So if you take this $1.75, you're basically just under $6 higher. So in this case, as far as how much do you make on the option? Well, you'd make the money you'd already had into it plus that $6 of appreciation, might just a little bit less than that, but you would have been putting up only 2/3 of the money you would have had to do with the stock, and you would also have the higher risk. So I would hope that you're starting to see how using a situation like this, especially when you're taking a counter trend trade, who knows, the market may never have exploded through the upside target like it did. This happens to be a good situation, and also guides you in a way that shows you how money management is important. Once you hit your trades, you execute them, you get out of them, whether it's a win or a loss, and then you know where your capital is at. You can manage your money and your next opportunities much better when you do so, instead of just dangling. There are a lot of people one of the biggest problems traders have is they have a plan, such as like the situation we just talked about, and then they just turn around, and that when it gets to a certain level, like it just did in this case, instead of getting out of the option or the stock or whichever way you would have gone, they decide to say, you know what, I'm going to hang on to this for a little bit longer. It's already up here. The market's never going to fall back that bad. Well, never say never with the markets, because never always happens. I'll just tell you that much right now. Okay, so let's look at what happens here. So when you sell to close this, you can see once again, now the order is different. It's sell to close. Quantity 1, the February option, the $25 strike call, and then you're selling the bid. Remember, you buy the ask, you sell the bid. Here's the 760, and then you verify that ticket. And then what happens is you get your verification result, and you can see status. Your order is ready to trade. Sell to close, 1 contract. Remember, you only have 1. And then the HP, once again, it shows you the expiration month, the strike price, and it tells you your estimated proceeds. So in this case, it would be $760. Okay. And then obviously you do have a commission fee that are subtracted from that. So your total proceeds off of this trade would be $757.83. Now let's see what happens here. Once you do confirm it, you get filled, just like when you did the entry price. Remember that? So you'll get the filled, and then you also have the confirmation of how much you brought in from that trade. All right. So now let's take a look at INT. This is an example also of where the market had made a bottom right around the beginning of December and had been in a down trend. And similarly, just like the last example, you made a lower move high, a higher move low, and then you peeped up a little bit and you made a higher move high. Now, during this time, in between this higher move low and this new higher move high, your moving average is crossed, which starts to show you that the market is either setting up for a neutral to potential turn, since it had been trending lower. Now these averages are turning up. And on this day, your 50-day moving average came right into just below the where the market was trading at, or above where the market was trading at this point. But the market had already popped through that average line. Okay. So similarly, here's another one with a $25 strike price option. In this case, instead of using one that's closer to the market, we're using this one here because I figured with the way the options were priced, and especially with the time going out, there was only same distance as the other one. It's a February 18th option that was expiring within less than 45 days. And this was right at the low. So I figured if this is your risk level as far as for a stock, if you're going to purchase it, or even for looking for a strike price, base it off of this and then use the major swing low as your risk level if you were buying the stock. So this is a good little area, because if this market was going sideways, if the option just treads along, you would most likely have a good chance of getting out somewhere around the market price of where it was during this time. If it goes sideways, meaning that it's constantly staying right around this $27 mark and staying above the $25 mark. So you would lose a little bit of your money potentially on the option if it stays sideways. But as far as a breakout to the upside, you have every reason to think that it may occur. Remember, we have our trend analysis that was giving us a reason because of the higher move high. The averages, they give us this little scenario here, giving us a little bullish potential. So we look for our upside target, just like we did with the last example. We use our 50% and our 0.618 level here, which gives us this bottom end of the range around $29.68 and the upper part around just under $31. Okay. And the nice thing about this target range is it comes in just around this area, just above where this downward sloping resistance is that's keeping the longer term downtrend intact. So if this was just a corrective wave that's going to fail, this would be a really good likelihood that this is where it's going to run out of gas as far as being the extreme for any rally that would happen after this date. Okay, so $25 strike price for the call. If you bought the stock, it would cost you a little over $2,700. Now here, let's see what we have here. So we have the trade is above the strike price. Recommend holding the long until the expiration day or a sell signal occurs. Okay, so when we look at this as a little bit more of a blown up view, okay, you can see that the market we initiated it back over here. Okay, this was where we entered it over here. The market did make a higher move high. It made a higher move low, and it made a higher move high again, but it's really only trading just slightly higher. Remember how I said this option, if it goes sideways, will probably bobble around this 27 to 25 area. Well, that's pretty much what it has been doing. Although it's been lifting, the lows are getting higher and the highs are going higher as well. It didn't go by much. I mean, this here was right around just above $29, and this here is just a little bit higher than that. So you're talking about just pennies above to make this move. So this is becoming very static. So what do you do? Once again, we recommend holding until expiration, this was actually for last week when it expired. And the reason being is that there was so little time left, it would be better to wait and see if the market could pop up. Then since there's not much time left to go and your risk was already pretty much capped. So you wouldn't have gotten much for the option. For those couple dollars, it would be worth to keep since the market was trending higher, even though it only grinding higher, there's a chance that you would get the market up to around $30 or something within that weekly time period. So let's see how things were going here. All right. So we have our screen here that shows the trades that we have going on. So we have the INT position here. We had an opening price of 350 and the bid is at 330. So like I said, to hold it, you could scratch this trade right now. My recommendation is, because it's trending higher, would be to hold that option for another couple of sessions. As far as any big expectation, once again, I don't think that there would be much there, but there is enough strength in this market because it's on its highs. You can see that you're right just below where you purchased the option. So if you were to sell the option out right here at 330, you would only be losing 20 cents minus your commissions, which is nothing. That's only $20. So as far as managing your positions, that would be a decision you would have to make on your own. Obviously, in this situation, I would say my theory would be to hang on to it at least for a couple more sessions and see where it would go before you try and scratch that trade. Now, interestingly enough, when you look at the e-option platform, remember we sold out the HP here. Look at the P&L here. So the market average price of that option from the last webinar was $1.75. Look at the bid, $7.70. That's a difference of $6.05. So that was a lot of vig on that one. That was a good bang for your buck for that options trade. DraftKings, which was a carryover from the last one. We're going to get into an example. This option was an average at 445, and there was just over $1 left on the bid. We'll go over how to manage that one now and what we would do with it. So remember, if you were in the last webinar, we had this DraftKings position. And the question now is, with this one, would you hold it or would you get rid of it? Well, this market obviously trending lower, making lower move lows, lower move highs. However, it did have a potential head and shoulders forming, meaning that this was a lower move low. Okay, this was a lower move low as well. However, once this made a higher move low here, it started to become like a head and shoulders bottom. Okay, now a head and shoulders bottom means that this is the shoulder here. Now this is an upside, it's a reverse. So you think about it, if it was right side up, it would look like a normal head and the shoulders, but this is upside down. So think of a person upside down. Here's one shoulder, and you start to pull back. This is part of your trend. Then you break down to your head. This is your head up here, and you start to come back down here, up to this level, and this gives you your shoulder bottom right here. So when you take this high and this high, this gives you what's called a neckline for your head and shoulders. Now, in this case, you have your averages that are starting to flatten out. You had made a lower move low, a lower move high, a higher move low, and you were coming right up against the neckline if this is a head and shoulders. If that's the case, a bullish breakout to the upside would be expected. Now, this market's been trending lower and lower and lower. As you can see, it was at $68 back during the fall, and down here, it wasn't looking so good. You'd think with the NFL going on and playoffs and what have you, and everything going back online, that a company that's is doubled their revenue, but for some reason their profit margins are decreasing like you wouldn't believe. So anyhow, on a technical basis, we have a reason to buy this trade. So $25 is our magic number for strike prices today, at least for the first three examples. Why? Well, because it's right below the head and shoulder. And the reason for this in this case is that if the market does fall below 25, the bear market is in, that this market, it's time to get out of that one. So that would be an idea where if it falls below it, you could scratch it and take your not scratch the trade, but at least take your licks and only lose a little bit on that one. As far as buying the stock in this example, and this is where options give you a much better reason to participate in certain markets. This is a very big bear market. To try and pick a bottom or a top is not the thing to do. I would say the option is the way to go with this. So let's see how this worked out. All right, so we have the DraftKings example, okay, and what happened here? Did we get the head and shoulder? No, we didn't. The market kept on breaking. So that last example was from the first option. So what do? Well, that option had enough time to expire going into it was last week, actually, and the market was coming back towards this $25. So whereas when I showed you the example before, the market took a heat. It broke all the way down to this basically around $17 before coming back up right in this lower $20 range. Now we look at it, they continue to make lower move lows. Okay. And once again, we have this, remember, here's where the $25 buy expiration, the first trade, the market just boom, 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 boom. It made this lower move low. Then it made this lower move high right here. You can see with the arrow, it's very tight. So that's why these have all these arrows here. Then we made a higher move low here, a higher move high here. And then this takes out the longer term downward resistance line holding this trend intact. It came off of this high here. So that is a bullish indication right there. Plus now you're making a higher move low again, and you have your moving averages that are flattening out and trying to turn. So at this point, keep the original option, bullish setup, and not much time left. Keep this up. Now, we're expecting it to go all the way up to $41. Well, that certainly would be nice. However, that's not usually the way things work. But since it was right near the strike price, there's no reason why you wouldn't think that you would have the opportunity to potentially salvage part of that first option. And since now you have this buy situation again, well, would you want to use the stock and spend $2,300 and then try and catch a falling knife, which I would say you shouldn't do. But if you are bullish DraftKings and think that their profit margins, the fundamentals don't make any sense for this company on any level. The dollar numbers they're printing money, and somehow they're hemorrhaging at the same time. So, but let's say you think that it's a good takeover possibility, especially at these levels, or for whatever reason, we play the $25 strike price again, but this time with the March 25th expiration. So now you would have two trades on. Okay. So now once again, to place this order, you have an option, buy to open, quantity one, March 25th, 2022, and then also the $25 strike. And as always, be sure that you have call when you want to call entered properly. The bid here is 214. The ask is 229. Remember that you are buying the ask. So that's 229. We go to our first verification result of putting in the trade. It gives you your estimated cost of $228 plus your commissions. Comes out to around $230.16. Then you have your order placement once you've verified it. And then once your status says filled, you have locked in your risk. You know that right now that new option costs $230.16. And that's all that you can lose on that option, or potentially make more plus that price plus more, depending on where the market goes. So once you can see here now with the trades that we have managed, and one we had gotten out of, we had entered an extra one. So now we have your INT position, your HP position, and your 2 DraftKings positions, one that's expiring within a week of this example, and one that won't expire until March 25th. So in this case, it also shows you your P&L in a day. Remember, since you sold out the HP from the previous webinar for a $605 profit. And then here's your market value of what it cost you to put on these positions. So that covered pretty much almost majority of the cost of the new options. And underneath here, it shows you also your total balance of trades. All right, now let's get through Peloton real quick before we get to questions and answers. All right, Peloton, why did we pick this one? Well, the news about Amazon getting involved with them and Apple and a bunch of other things, could that save this company? All right, so for you bears out there and those of you think that this stock is going to zero or it could really hit support even more, well, here's the things that can help the bulls in the short run. We have this gap right here, this big gap from November, okay? And on all your averages, you can see how they're sagging lower and lower and lower. Lower move lows, lower move highs, okay? So we had this high back in October up here. This is over $100 or right around $100, okay? Then we come all the way down to the end of January. We hit this lower move low, lower move high. Then we make a higher move low. We have this right when the news came out about Amazon getting involved with Peloton. Okay, so fundamentally, this company is a basket of mixed goods as far as the numbers. They have issues. Their management team is probably their biggest cross to bear, which that's why this market probably rallied as well, because they changed out the CEO right off the bat, although they still have a majority of their management team. Ultimately, the captain of the ship and the officers are responsible for what happens, so they're the ones to blame. There's supply chain issues, blah, 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 all the reasons in the world where the bears would like to sell rallies in this or just sell it. Now, I wouldn't suggest shorting the stock, but buying puts on this is a very good way to play this market. Now, in this situation, if you're playing the news and riding the Amazon train, then this market would be something that you would be looking to rally in a big way, okay? Especially because with having their interest in Amazon with their marketing ability and their outreach around the world and supply chains, this would be something that you would probably expect to have a lot of success moving forward, okay? So let's see what happened here. So we did have this nice little move, and the bullish setup, option play equals buy a call. $37 strike price. This is our line in the sand here, because this is where the market's right above the 50-day moving average. Remember, we spoke earlier about the 50-day. So within a matter of just a couple of days, it had gone above the 13 and the 21-day moving average. They're starting to cross to the upside, and the 50-day moving average, it exploded above that as well. So on the bullish setup, buy a call, $37 strike price. Now, this stock is a dog with fleas. Option play, buy a put. Once again, for all you bears. So just like there's a reason for this gap, all gaps typically get filled eventually. That gives us a reason to shoot for this upside target area. And with this, we use the Fibonacci, the 50% and the 0.618. That gives us this basically just under $61 to just under $70 as our upside longer term corrective move target area. Also, April 25th is the option expiration for this. Plenty of time to have this market rally, ride the Amazon train, get things back on track. Peloton's a great product. Everyone loves it, blah, blah, blah. Well, if you're a bull, this is the area to look for. That is, the risk here is not too much. Now, buying the stock would be a really bad idea. Even if you're really, now, if you own the stock, adding to it also would be a very bad idea, because just right now it's short-term news. You don't know what's going to happen, and it will take a while to manifest. And once again, they have huge supply chain issues. There's things that Amazon, they can help with certain things, but they can't help with there's other things that their hands are completely tied on. So be careful of news events. And this is also where you can capitalize of news events. Remember, I said, if you're a bear, you're looking to sell rallies. So you would take, instead of shorting the stock and taking that kind of risk, $37 strike price would be what you would buy a put at. Now, we're going to use this example. This is not a spread. We're not talking about a spread here. We're not getting the straddles and strangles. In this case, it would be a straddle by putting on a put and a call at the same strike price, but we're not. We're just showing you the bullish example and the bearish example. Okay, so in this case, we would buy to open 1 March 25, 2022, expiration, $37 strike price, call. Okay, and this one is the first one. You get your verification result, 447.16 is your total cost. You hit the verification, then you get filled. In this case, it gets filled at that price. All right, so that adds that position to your ledger, and you can see once again where your average price is and where the market is trading at that point. Now, let's say you buy the put. Now it's the same thing, option buy to open 1, same expiration, same strike price. However, this is where I've been trying to reinforce this in you. Make sure you put the proper type of position. This is a put, and then here's your bid and your ask, which gives you then once again, when you hit confirm, and now we show in our ledger both trades, both short and both long. Now, to let you know where the market went to, it is now trading at 27.18. So after that day that it popped up, the market traded lower. So not much of a change in the market since then, just a little bit lower. The call, you can see right here, this was where it was entered at, what have you. Now I'm going to show you where it went to after our GE example. So we have a put and a call on that one. And then real quick, we're going to fly through this. GE, this is a bearish example. We want to talk about a put. So that we're going to play the trend. The trend is making higher, low, from a lower move high, lower move low, continues to do this. And then here we had a question. It came into our downward sloping resistance line, holding the trend intact. The market had gotten above the moving averages, but it looks pretty sideways. It looks pretty weak. The broad market looks weak. Expiration, there's not much time there. So as long as these averages are flattening out and not starting to trend higher, this is a good time to maybe play the put and look to sell rallies, because this market has been failing. So if this is a corrective move here and it's failing, this $100 strike price would be a good put to take off, add to your trading list. So once again, buy to open, 1 contract, March 25th, $100 strike price. It's a put. Okay. And then that gets verified, and all of these stocks are in your menu, and then you can see your positions. And you also see here, like unrealized PNL, minus 367. But when you look at that, we had brought in $600, and then you look at all the options you just purchased. Even on the count value from the last webinar to this one, these positions are positive. So not that you should be following these trades, because you can't, because it's in the past. So, and then as a current update, we'll get to the questions in 1 second. This shows you where the markets are at, the account value, and right now the unrealized P&L is at 264. We still have, now remember, 1 DraftKings expired. We still have the 2 Peloton options on. As you can see, the opening price was $5.15, and the put, remember the put, since it's lower, that one is at $9.30. Now the call is at 87 cents. That dropped drastically. So you're up on that position in a big way, which is nice. So in this case, your put is golden. If you want to get out of it, if you think that this other stuff is going to work, then that'd be a great time to take your money off the table on the put and roll your dice on the call. Who knows? Maybe the market bounces and that comes back in your favor. But that would be up to you. We're not going to go over those examples on where that's at. So with that, we are going to look at some questions. Okay, can you request a price lower than the ask? That's a really good question, Emily. Okay, so when you want to get a different price than what is at the market, whether it's your bid or your offer, that's where you have to put in a limit. So when you place that in, and that's something that I was thinking that we should start to have for some other webinars, is to fine tune order placement, like for instance, which would answer this question. So yes, instead of going to the market, remember when we set up the trades and where you marked it was, I said all these examples are market orders. Instead, you would put in a limit. Okay, so then you would have a buy and you would put in a limit price. So in that case, if you wanted to have a bid, and so this works for both selling and buying the options. You put in your limit price. So let's say the market is, for easy numbers, 2 at 3. Okay. And you didn't want to sell the 2s. You think that you have a little bit of time. You want to see if the market gets up to 3, then you want that price. So what you would do is you would put your limit in to sell the option out at 3, or conversely, you could buy it lower, say the market's 2 at 3 and you wanted to buy a 1 or buy a 2, instead of paying for the 3, you would put a limit to buy at 2. And the only way you would have a position is if the market actually hits your price. So if the market never falls down to your better buying price or raises up to your better selling price on a limit, you'll still have your position on. So you do run the risk of the market moving, let's say, further away from where you wanted to go, because you wanted to maybe make an extra couple of price increments, whether it's buying or selling out of an option. So that's a very good question, Emily. For the beginner videos and for this, since we're not totally isolating the actual trade entry like that, like fine tuning it, that's why we use the example as markets. Now, one thing about market orders and getting in, this is really good that you brought this up, Emily. When I'm looking to pick my options, it's unless the market's really gyrating a lot, I typically will use a limit. The reason being it's an old trading rule that I've learned from the floor, whether you're on or off the floor, to try and get in with the limit and get out with the market. A lot of times, as far as getting out, you don't have time to waste with the limit because you're going to be eroding your profitability. And especially with options, if you have a winning position and volatility, like for instance, let's say, in these situations, you're buying the options. So volatility is a function of your price. So no matter, let's say it goes in your favor, whether it's a put or a call. Okay. And it even happens in a short amount of time frame. Okay. There's variables on that pricing. So if the market just stays where it's at, you're pretty stable with that position. You're not going to gain or lose very much money. But anything could happen, like for instance, there's a news release. In this case, let's say that, like the Peloton example, let's say all of a sudden it comes across the news that Amazon's decided to completely just ditch the whole Peloton deal. What do you think that would do to your call options? If that happens, they would go much lower. Your put options would obviously go up in value in a big way. So if you were close to, say, your target point, and especially if you get in your target range, remember how I said, like, if you use your 50% to 0.618 and or whatever your target is, if you hit your target, get out at the market. Don't waste that little price increment, because that's when you're being penny wise and dollar stupid. You're more likely to, over time, cost yourself money nitpicking that kind of a trade, getting out. And especially if you're on the wrong side, or you're confused, or you made a mistake on getting into a position. That's why I said be careful about how you enter your orders. Be very don't be careless about which, when you enter them. Make sure your quantity is right, your direction's right, meaning whether it's a call or a put if you're buying. Because professionals do it all the time. It's not just beginners. People make mistakes. They forgot to wear their glasses that day and the screen looks a little different. I'm getting older. Definitely, it's kind of funny how I look at the screen now. I have to have my glasses. And these are things that matter, because if you enter the wrong number or click something, overlook it, you're going to have either a wrong position on, or you're going to pay up for a position differently. So very good question, Emily. These things are definitely variables you want to take into account when you're placing your orders. It's like, I don't know if any of you ever went to Catholic school or private school, but I remember I went to both, and in both cases, they're like, your carelessness is going to be the worst thing that can happen to you when it comes to your work, so don't be careless. If you're trading as a business, if you're careless with your business, you're going to have careless results. So don't be careless, and at least try and solidify better profitability and stuff like that. Let's see, do we have any more questions? We don't have very many questions today. So I hope you guys enjoyed this webinar. Oh, wait here. If you're putting on a call and put at the same time, will the platform recognize two separate trades? Of course it will. Now, that is the great question. Now, we are going to have, I haven't used the platform for many of the webinars that I've done up until the last couple of months. And I think that the viewers such as yourself like this, showing you how the platform works and enters. In this case, we were using two separate examples, a reason to be a bull for Peloton and a reason to be a bear, just like we were being a bear for GE. That's why I said it's not a spread. Now you can enter, that would be a straddle. When you're buying this and selling, when you're buying a put and a call, okay, simultaneously with the same strike price and the same expiration, okay, that would be a straddle. Okay. Now that is a spread. Now there is a way of entering that order into your platform. You can go to the market, but this is where the limit comes good, because when you're buying spreads and selling spreads, you want to then try and get your price, because the market can move away from you. And even though they're very liquid, your price differential on your spread could be a little bit wider than you would probably like, or that you would get if you put in the limit. So that's actually a good example, a good question for me to incorporate into one of our next webinars. And I'll talk to Gina and the rest of the people at eOption about doing that. We've done examples on spreads before, and maybe it's time that we do one with that. I know we're getting close to the end, but we'll answer a couple more questions, and then I will wrap things up. And Emily, by the way, thank you very much. Fantastic questions. For Greg, hello, can I watch it again? I was late. Of course you can, Greg. This is being recorded, and Gina and the eOption crew will have this up on their your YouTube channel, eOption.com or eOption on YouTube, as well as on their website. And I think everyone that's an attendee will also get, I think they email it out to you as well. So yeah, you'll be able to watch this webinar. Appreciate your interest. Please take advantage of watching it again, and you can always submit questions to them afterwards as well. And Pauline, let's see, why would you choose to buy a call and buy a put instead of buying a spread? Once again, that was for the example. Didn't want to confuse this webinar with spreads, straddles and changing topics. The main thing was to have a bullish setup. However, because of the fundamentals and the technicals were bearish for the Peloton stock. So it was a good example for a bearish trade, meaning buying a put. The news with Amazon, buying the call. And that's where you got to be careful with news. Okay. The reason if it wasn't for that news, I would have just used the put example and not the call. The call was only because of the news. And I was also wondering whether it would be a news fed rally, or if it would be buy the rumor, sell the fact, meaning that you buy the rumor came out, the move has already happened. Once you know it solidifies happening, all of a sudden the move is done. You get out. So that's where it's a false rally. And that's most likely why you've seen the sell-off in Peloton, because once again, they have a lot of things to implement before they can overcome, especially their management team, which is a bunch of clueless guys. No, not to be too picky on them, but they really made a mistake with what they were doing with that company, but they're on the right track now. The new CEO should turn things around. All right, Greg, you're welcome. And let's see, with that, I'm going to show you one more slide. And just to remind you, I wrote the book, High Probable Japanese Candlestick Patterns. It's available on Amazon.com in paperback and Kindle versions. Also, if you wouldn't mind, subscribe, like, and share Forex Trading Unlocked on YouTube. Check out my channel as well. And you can use the patterns in my book to use trading options as well. If you're using whatever market underlying asset that has options, you can incorporate those these signals and use those trades, which actually we've used in some of the webinars, some of those signals to give you ideas. All right. So with that, we're going to put on this slide here for you about e-option and turn things over to Gina.
Great. Thanks so much, Teddy. That was very interesting and informative. And thank you to all of our attendees today for taking the time out of your busy day to join us. We really do appreciate it. And just a few reminders before we go. As Teddy said, a recording of this webinar will be available tomorrow on our YouTube channel for e-option. And make sure you subscribe so you don't miss any of our videos. You can go to youtube.com/eoption and sign up right now, and you'll make sure to get everything that we offer. We do have over 100 videos on option trading, and we just recently revamped it. So you can find all kinds of playlists for beginners, for tools, for spreads. So whatever you're interested in, we encourage you to check it out. And also, as Teddy mentioned, one of the great things we offer is a paper trading account. We call it also a free demo account. So if you go to eoption.com, you'll see a big blue button that says free demo account. If you click on that, you can sign up for it. And basically, you'll get 100,000 in virtual cash to try out your option trading strategies or your trading strategies overall. And you can test our trading platform, see how it works, get comfortable and familiar with it. With such wild swings in the market and all this crazy volatility, you could just try out some of these strategies risk-free and see when you feel comfortable, and then go in and open a live trading account. So it's really a great feature, and we encourage you to go on our website and check that out. There's no obligation, and as I said, it is free. And if you are ready to open an account and you don't have an account with us already, again, you can go to eoption.com. There is no minimum to open an account, and all accounts are SIPC insured. And our parent company, Regal Securities, has been in business for over 45 years. So we really do cater to investors and servicing them. One of the great things about eOption is you'll get access to all of our free tools. So you get over $500 annually in free tools, such as Options Play, which scans thousands of stocks daily and highlights potential option trades for you. We also offer something called auto trading, where you can get your favorite newsletter alerts automatically traded for you, and that's pretty unique to eOption. And we also offer unlimited free research reports. So we encourage you to check us out. If you do go to our YouTube channel and watch this video tomorrow, you will see in the description a special promotion where we will give you free stock for a limited time when you open an account. So make sure that you don't miss that, and check out and subscribe to our YouTube page. And so I also want to just mention our next webinar, which is coming up next month on Thursday, March 24th at 1 p.m. Central Time. And it's called Rolling with the Market, Adjusting Your Option Positions, sponsored by the Option Industry Council. So mark that in your calendar. You can also reserve your spot today at eoption.com/webinars at the email address on there. So thank you again for your time. We greatly appreciate it. We know you're very busy, and we hope you have a wonderful afternoon. Thank you.